Is it a good idea to use high dividend paying stocks or REITs with the radioactive trading married put position? Of course, the idea being that if we're getting a 10, 12, or 11% dividend, having only a 5 or 6% risk on our position might guarantee a 5 or 6% return over the course of the year. We get this question now and again, and it came up again on our May 8th webinar from William. William said there are a lot of companies that have fairly large dividends, well over 6%. If a married put strategy was put on one of these companies where the initial trade risk was lower than the annual dividend yield, would this be essentially a riskless trade from the beginning? If one was planning to hold the stock for at least a year, being that the dividend over that year would cover the amount at risk, not including application of any of the 12 income methods that we use in the radioactive trading techniques. Examples, WFC, XOM, and so forth. Can you comment? Well, absolutely. Now, we've been trading the radioactive techniques ourselves, Ernie and myself, since about 2007 and 2008. We received this question several times, and we ran several examples, and Ernie went ahead and put his money where his mouth is, so to speak, in 2011. He went into Annaly Mortgage, NLY, buying shares of stock at $16.70 and buying a 1 year out January 17.5 put for $3.45. Total cost basis was $20.15, guaranteed to get $17.50 back, so the total risk was $2.65, or 13.2%. Annaly pays a dividend of 13.6% annually, based on the cost at $16.70 when Ernie entered the trade. The dividend alone would cover the cost of the insurance, assuming the dividend wasn't lowered or the stock price fell to where 13.6% was not equal to or greater than the $2.65 at risk. Now you see various trade briefs here from May of 2012, June, and October as well. But you don't see any income methods. He didn't sell any calls against this position. He didn't adjust the put option. He didn't do one of the riskless spreads. And then about a year later, on December 27, 2012, Ernie sold to close the put for $3.10 and sold to close the stock for $14.11. It did have a 15% decline, so that full $2.65 dividend was a little bit lower based on the current price of the stock. Turns out the position was a loss of 1.6%. Now, it's much better than losing 15.5% on the stock, then taking in the dividend there and having maybe a 2% loss, but it was still hedged by some of the put action, of course, the dividend had received. But this is what we've seen, and since our tests from that point, when Ernie did the actual trade, other tests we've done, the REITs and the high dividends typically do not have a lot of movement. They stay inside a channel usually, which does mean lower volatility, which means with the lower volatility and the high dividend expectation, there's typically not a lot of premium in the options to do the income methods effectively over time. Why is the risk so high? It's because that dividend is priced into the cost of the put. So really, any return you'd expect to see with this approach in the married put system would be based on the growth in the stock itself. Not going to have a lot of premium for the income methods. You're probably not going to see a lot of movement, and the dividend that you want to receive is priced in. But to William's question, XOM is not a REIT. It does have a high dividend, but it's not extraordinarily high. The stock's currently trading around $42.30. XOM pays a 7.9% dividend, so 87 cents per quarter, or about $3.48 annually. Now, if I went out and bought a put at January 2022, I could expect about 7 dividend payments, including if we got the one on May 12th, if we'd opened this position on Monday, for example. And this would be a dividend of $6.09, assuming the dividend isn't cut or the price doesn't fall dramatically to where 7.9% of $20 is much less than $3.48, for example. Now, the proper married put structure in the radioactive trading techniques, we know we're focused on January 2022 for William's example. But we don't want to go more than 20% in the money. And typically we want to stay 1 or 2 strikes in the money with the proper structure so we don't have too low of an expectancy of profit. If I go too deep in the money, I'm going to see a much larger growth. So here we could buy shares of stock around 42.07. And we could buy the January 2022 47.5 put for 13.03. This would roughly give us a cost basis of 55.10. We're guaranteed to get 47.50 back, so the max risk is 760 or 13.8% for about 620 days. Now, with getting a 609 dividend payment, assuming we got all 7 and the dividend price stayed about the same, we'd still have to cover about $1.51 or so, or $151 for the difference between 609 and our 760 at risk. But there has to be other strikes. We can get a lower risk, can't we? Well, of course. If we go deeper in the money, we can lower the monetary and percentage at risk. Well, what do we need? We need a risk of around $6 or so, and we see that happen right around the 60 strike put. It has a price of about $24, so if I bought the stock and bought the put at the ask price, we'd have a total debit of about $66.10, $66.11, so our maximum risk would be $6.11, or 9.2%. But over the next 618 days, if we collect those 7 dividends, we'd have canceled that risk without even applying any other income methods if possible, or not including any growth on the stock. But that's the key. This put option is 42.5% in the money. In order to apply an income method properly, I'd need the stock to be trading around the put strike price at around $60 per share, a 43% growth on the position. Also, we won't see any profit from growth beyond the cost basis of $66.11, which is about 57% in the money. Anything beyond that would be extra growth in addition to the dividend covering our payment. This is why we don't expect to go too deep in the money, although we do have the risk covered by the dividend in this case. Any expectation of further profit beyond that is extremely low and might not be worth our while for holding capital in place for 620 days. In the radioactive trading techniques, it is okay to use dividend stocks, and that's discussed in the blueprint, but not the high dividend REITs or other high dividend paying stocks. We feel it is best to keep the dividend below 6% in the Married Put approach. As we've seen the high dividends, we can expect lower growth, less movement, which also causes lower volatility to make it harder to get premium for doing the other income methods by selling calls or riskless spread trades and more. The higher dividend is priced into the cost of the put. So that's why it is so high, and that's why it might be harder to make the position truly no risk, or if you go too deep in the money, where the risk equals the dividend, your expectancy of any profit beyond that is very low. Now, to be fair, a side thought on that in William's question, he recognized some of this, and he says, well, I realize the company could potentially cut or suspend the dividend, as we just saw with Disney, which dropped it out of the dividend aristocrats there. It might cause the stock price to fall. Would it then be a profitable trade to the downside because of the long put? Well, no, it would still be low risk as we saw in the graph if the stock falls. We saw about 14% for 618 days out in time. But it wouldn't be a profit, it'd still be the risk. We had that risk of 13.8% on the position. If we receive a few dividend payments, maybe we get some premium with the proper structure here. If the stock, in our case, moved up to 45 or 46, generate some income with income method number 1 that's talked about in the sketch and more detail in the blueprint, of course, as well. But if they suspended the dividend, whatever risk we had left is still our true risk to the downside. It's not a profitable trade. But there are income methods discussed in the blueprint which could give you a structure that if the stock starts to fall, you could profit to the downside as well as profit to the upside, even though you're long the stock and the stock is falling in price. William says, would you recommend one buys the blueprint before becoming a subscriber? If you're seriously considering, and I think everyone should, but if you're seriously considering using the Married Put techniques and as part of your portfolio, I personally, if you heard me mention before, just cleaning up here, folks, you've heard me mention before that for the last several years, about 50% of my trading capital has been allocated to the radioactive trading techniques, then 10 or 15% in the bull put credit spreads, 10 to 15% in some of those diagonal spreads, maybe a couple standard collars here and there for good implied volatility, and then potentially a couple percentage doing lottery tickets, playing earnings straddles with a low amount of capital. So if this is going to be a larger portion of your portfolio, you're going to implement the limited risk trading techniques with a larger part of your portfolio, I would suggest buying the blueprint. You'll get the 30 days free, but the 30 days doesn't start until you first activate it, William. Okay, you can take your time, study the blueprint, and then when you're ready, come into Power Options. And the blueprint does show how to use the various Power Options tools to implement the radioactive trading techniques, as well as the full philosophy, the SIGA model for each income method, the do's and don'ts as well. William, if you're currently trading some covered calls, you've got some naked puts going, you're interested in credit spreads with a portion of your portfolio as well, well, I would say subscribing to Power Options and buying the blueprint is good because you can track and manage your positions, use the portfolio tools to help you with your analysis on those positions that you're currently trading while you're studying the blueprint, and then you still get the 30 days for it with your other positions. Okay, so that'll still be active there as well. The Married Put, Trader Rick, the Married Put is based on owning the stock. So that's, you're going to have to buy, to get the single digit risk, you're going to have to buy the stock and buy the put. That's how we get the single digit risk. Just like with a covered call, you have to buy the underlying security. So in general, if I was starting with radioactive trading and the Married Put techniques, I was looking to open 3 or 4 Married Put positions, I'd recommend you start out with maybe $12,000 to $15,000 with smaller portions, and eventually you can build that up over time. But it is capital intensive. I never lie about that. I never tried to hide it. We are buying the stock to get the single digit risk. I remember when someone says, isn't that just the same thing as a long call? Well, the risk reward profile is the same. We're not saying that. But remember, leverage works both ways. If you buy a call, you're risking 100% of what you invest into the position. And we've got, I'll probably send some email. I'll send you a webinar link to something we talked about last week, our 3 core principles in trade comparison. We compare the Married Put to the idea of getting into the Married Put cheaper with using a diagonal put spread or a naked put, or the Married Put versus the in-the-money long strangle. That's what we talked about last week and just posted. Or buying a call position is the same as the Married Put. Well, if I have $5,000 to invest, I do a Married Put on a $45 stock, I'm going to end up with a 5% risk of my $4,500 invested. You say, well, I can do the same thing. I'm going to buy one call. I've got $5,000 to invest. I'm going to buy one call on this position, and I'm only risking the same monetary value. And you're correct. And what do you do with the remaining $4,800, $4,700? If you buy 5 calls on stock ABC, 10 calls on stock XYZ, 6 calls on stock 1, 2, 3. Now you've got more of your $5,000 allocated, but you could lose 100% on all 4 of these positions. That's why it's not the same, okay? Yeah, the max risk is usually between, the maximum risk with the proper structure is usually between 5 to 6%. I'd say 4 to 7% is usually the risk structure, and in general, the put is usually, we recommend going at least 150 days out. My average is about 210 days out in time, but I don't hold the positions that long. That's for the best insurance following the 3 core principles, Trader Rick, in that scenario. Octavio says, Mike, will you ever sell a call to hedge a stock? No. Anytime I trade a stock, I'm in a Married Put position. The only other, I won't do covered calls anymore. I don't do covered calls anymore, period. If I like stock long-term, I'm using a Married Put. If I like the value of premium short-term and I think is a good opportunity to make money, I'm trading it as a standard collar, which is selling a call. Now, Octavia, if you're talking about the Kraft position, I already reviewed exactly why I haven't sold a call on Kraft, the new Married Put position there as well. Okay? And that'll be in the archive. You'll be able to check that out. Okay. All right, real quick, the general base concept of this. Oh, Trader Rick, here we go. I'm not sure if you're on Power Options, but what I want to do here is there's a 4-part article that Ernie wrote when we first started getting involved with radioactive trading techniques in the blueprint. The covered call challenge, limited risk solution, married puts and collars, okay? This article here, let me just see it. I'll send you the link real quick, okay? In the chat, well, I'll send it to everyone in the chat window. Here we go. There we go. So it talks about the structure of the trade. Now, I'll send the article to everyone, but let's think about it here. How Kurt originally created this is that he was taught covered calls by the wrong person. I'll put it that way. But what he did is he essentially started trading covered calls, and then he got bold and started trading covered calls on margin, and then he ended up losing everything, followed all the rules and all the instructions from the guy that was teaching it. Eventually that guy went to jail for a little bit, the guy that was teaching it, not Kurt. But Kurt looked at it and said, you know, the money didn't disappear. It disappeared from my account, but it didn't disappear from the market. Someone made money with that decline. So what is the risk reward of a covered call? Well, if the stock moves up, stays the same or moves up, you'll make 2 to 3% return if assigned. You have some downside protection of maybe 3 to 4% to break even if the stock falls. Every now and then, once every 6 months or so, you're going to get a stock that falls 15 or 20%. Every now and then, you're going to have a stock that moves up 10 to 15% over time. You still make 2 to 3% on the upside. You hedge your losses by 3 or 4%, but you're still taking 10% losses. You need to be right 75% of the time with that structure to profit long term. The married put is a covered call flipped on its end, where I have on the stocks that move up 10, 12, 15%, I'll make 5, 8, or 10%, but the stocks that fall 20 or 30, I'm only going to lose. That's 4 or 5%. That's without the income methods. I'm going to use the income methods to lower that initial at risk and potentially bulletproof the trade to where I have no risk. About a fourth to a third of all the positions we trade end up being bulletproof. Okay? There's a unique tool I also want you to check out this weekend if you have the time. Go to radioactivetrading.com and click on the Resources tab, and you'll see this Trade Simulator tool. Now what this does is you can put in an expected target return, expected loss on average for your trades, your win-loss ratio, probability of loss, and set in an investment amount and how much would you invest. I have a default here for covered call, which is actually high, but implied volatility is high now. So let's say I'm looking to make 5% return if assigned when I'm right. And I know I'm going to have some volatile stocks, so I'm assuming 10% when I'm wrong, but I'm going to win 70% of the time. Okay? Now that's going to be a winning track record. I'll start off with $10,000. I'm just trying to get even to 70. It's random error. Let's go to 71. Okay, so after 100 trades, 71% win ratio, being making 5% when I'm right, knowing I'm going to take losses, but I only take it 30% of the time, we could take a $10,000 account up to $14,000. Okay, but if I had $10,000, it's going to take me many years to do 100 covered calls trades. Well, I'd probably do maybe 2 or 3 per month. So let's say 36, so about 3 years. Okay, that's maybe same with the married puts. My average return, and we post our trades on the Fusion subscription here at Radioactive Trading, my average return, and Ernie's higher, but I'm going to use mine. My average return is 7.1% on my winners, I believe. When I lose, I think I only lose about 4.1% on average, and I'm actually right 60% of the time. I'm sorry, probability of loss only 40%. After 100 trades, even being right, well, that's 65. Let's get to 60. After 100 trades, that $10,000 account would grow much faster because the losses are taking less out of the account, and I'm still managed to win. And yes, because I left the upside open and didn't cap it with a covered call, didn't worry about rolling it unless I use one of the income methods incorrectly, then I'm still good. I'm still strong. I'm still able to take advantage of more of the upside. Ernie's numbers are higher. He's at a 10% average on his winners, and I think 4.8, maybe 5% on his losers, but he's only right 50% of the time, but still works out to be higher as well. Okay. let's see, Chuck says, Michael, exactly what do I receive if I purchase the blueprint? Okay, well, it's, hold on here, let me do it this way. You can see it right here. The blueprint is the full text. Now, it's electronic copy now. We don't send out a binder anymore, Chuck. So you can get immediate access. It's the full, it's about 250 pages long. It's the full educational course on trading with the Married Puts. Never lose more than 4 to 6% following the rules. You get the full structure, discussion of how it all began. Each of the 12 income methods is described in the blueprint, plus there's a full chapter on exiting the Married Put, a chapter on combining the income methods, and there is a full appendix as well with examples and showing the different income methods. That's what's in the blueprint. It'll also give you a bonus. You get your first month of Power Options or a month free of Power Options, and you get, of course, the first month of that Fusion subscription I had mentioned for only $10. Regular price is $69. It's a separate subscription where we post our positions. As well. Let me go ahead and sign in again. Okay, so that's what you get, Chuck, with the blueprint. All right, now, track record. Let me go there first, and I'll show you mine. I think I had my numbers right. All right, so it's taking a while to load. It's loading all the history there. Okay, got it. All right, thanks, Martin. Thanks, Dan. Sorry about that. I'm not sure why that didn't send. Okay, I'm at 7 and 5 now. So my average win is 7, and average loss and losers is 9, and 58% win ratio, but that's still doing pretty good. Okay. So there's some of the recent trades there. Some of my favorite ones, of course, the stock down 32%. We made a 10% profit following the rules in the blueprint. Don't do that with everyone, but here's one that's a 30% loser and only lost 2.8%. That's sort of the power. Here's one that was up 37, gave some back to the put, only made 24% on the position as well. Okay, so that's what's shown in the track record. As I mentioned, let's go back. It's going to take a minute to load. Ernie's is higher. He stays in his positions longer. He tends to manipulate them longer and continue them, although I've started to do that recently to try to catch up to him, but it hasn't worked out as well for me. But I think his average return is around 10% on his winners. His average loss is about 4 or 5% on the losers. It's okay, Martin. He's not discussing the covered calls in 4 parts. I'll show you. I'll go right back to that in 1 second. 10.3% average on his winners, 5.4% on his losers. He's right 52% of the time. But again, over 100 trades, you'd expect that $10,000 account to potentially go up by a factor of 10 almost. And the important thing, though, the low value in that simulation is only 2 or 3%. That's the most you could expect. Okay. All right. So back on Power Options. In the Married Put tab, click on the Married Put tab to go to the Married Put Learning Center, Martin. Here is where those links are again for the covered call. This isn't discussing the covered calls. This is the covered call challenge, the problem with covered calls, which is why I sort of sent that to Trader Rick, the limited risk solution, how the Married Put solves the problem that investors experience long-term with the covered call strategy. Look at the Married Puts and Collars and how to find Married Puts and Collars using Power Options. That's right under the Married Put tab. Actually, click on the tab to Married Put Home, Martin, and you're all set. You said, okay, so Jim says, over what period of time is this for earning? Well, I've been trading the radioactive position since 2008. Ernie was a little bit before me, about a year before me. But that simulation we were showing you, the simulation, that wasn't our track record. That's using our numbers that we're seeing. For me, 12 years of trading the radioactive trading technique and Ernie for 13 years. That's our average wins and our average losses and our average success rate. That's plugged into that simulator tool that I showed you. Okay, this isn't the return on the portfolio. Okay, this is running the simulation to see what's possible with consistently trading in this fashion in the proper way with the limited risks techniques in that case. Okay, so that's what it's showing you there as well. Yeah, you just go to Married Put search, John. John says show for prospects for Married Puts. Yeah, I mean, we already looked at that earlier. We looked at that earlier when we pulled up the basic Married Put search and used an example. You just go to Married Put and you go to search. And these are the positions that we choose based on the radioactive trading default screens that are talked about in the blueprint for what stocks to look for in the structure. And this is what I would use as well. We just go right in here also. Okay, Trader, the Married Put Learning Center are just concepts and ideas and introductions to the benefits of the Married Put. It doesn't discuss any of the income methods. It doesn't get into depth into the proper structure. It doesn't talk about the SIGA model of when and when not to use each of the income methods, that is only contained in the blueprint. You won't be able to find that anywhere else for free. So that's the difference there between the two. Okay?